Hello, my name is Henrik Jeppesen. I'm the head of investor outreach in North America for the Carbon Tracker initiative. Today, I'm very happy to have our oil, gas, and mining team with us, represented by Axel Dalman and Mike Coffin, to discuss our latest oil and gas report, actually the 5th annual report where we are doing CapEx analysis in a climate constrained world. The new report was launched last week and it's called Adapt to Survive: Why Oil Companies Must Plan for Net Zero and Avoid Stranded Assets. This is the 5th year running we have done this analysis since our first report on the topic called 2 Degrees of Separation, published in 2017. I'll do a quick intro and then it will be followed by a presentation of approximately 30 minutes by Axel Dalman about the key findings. Then I will follow a moderated Q&A where also Mike Coffin, our head of oil, gas, and mining research at Carbon Tracker, will participate. And then we will take some questions from the audience, finishing up in about 45 minutes. Axel Dalman is our associate analyst on oil, gas, and mining team. He joined us in 2020, and he has already co-authored several of our very leading and important reports, including Beyond Petrostates and Pipe Dreams, and he has been very involved in our executive compensation work. Mike Coffin joined us in 2019, and he is now leading our oil, gas, and mining research team and focusing on the transition risk in these sectors. He has also been very instrumental for a lot of our groundbreaking work around the Breaking the Habits, our fault line report, which is the 4th edition of the oil and gas report, and we have done also the absolute impact series and participated in other parts of our research scheme. So I have a very good cover for our discussion today. But a couple of housekeeping questions or issues before we go in. This session is being recorded and the recording will be made available online afterwards. Slides will be made available upon request. And we encourage everybody to ask some questions in the Q&A box, which is you find here on the Zoom. And I assume everybody has had some experience with Zoom by now. I think we should just jump into it again here. So as mentioned, I'm the head of investor outreach North America, based in New York City. Carbon Tracker is based in London. And as hopefully everybody know, or most people know, we are an independent financial think tank focused on analyzing the impact for capital markets from the energy transition towards a low carbon economy, and the impact that will have for the capital markets, companies, and their investors. We do this via identifying and quantifying stranded asset risk, a concept we developed more than a decade ago. And we also work with the policymakers and financial regulators. But one of our core concepts is stranded assets, and this is our core analysis in oil, gas, and mining area, where we are focusing on upstream oil and gas. And as mentioned earlier, it's a 5th year running. We are doing this analysis where we are doing including work on around 65 companies. This work is also utilized by the Climate Action 100+ initiative, and there are multiple pension systems both in North America and in Europe who are using this in order to inform how they are allocating their capital to the upstream oil and gas companies. I will not take more of the time by now, but again, encourage people to ask questions in the Q&A box. And now over to you, Axel, for the presentation of Adapt to Survive.
All right, thank you very much, Henrik. Hopefully you can hear me now. So I'm going to run through the reports or the main findings of the report, and I hope it will take about 20-25 minutes, so we leave ample room for Q&A at the end of this webinar. Let's just start by thinking about some of the key messages of this report. So let's just 3 sort of big points I would like to make. First of all, 1.5 degrees or net zero 2050, which are quite similar in their implications, mean no new oil and gas projects can be developed, as highlighted by the IEA in their recent report from May, but also what we see in our results as well. And that means that oil and gas production falls very fast over the next decade. Now, even in sort of slower low carbon transition scenarios, fossil fuel demand falls very rapidly. And that means that companies face significant stranded asset risk. And one of the main intentions of this report is to identify where that stranded asset risk is concentrated and with which companies. And so finally, that means that investors need to really ensure that companies change now and change rapidly to both protect the climate, of course, but also to protect the value of their own investments. So let's start with this point of 1.5 degrees, or net zero 2050, which really, like I said, have sort of very similar implications. And they're becoming quite widely accepted benchmarks these days for robust climate action. We see that governments are taking a much stronger stance on this. So currently half of global emissions are covered by some sort of governmental net zero 2050 ambition. Investors obviously are growing much more aware of these issues as well. Shareholder climate votes in favor of stronger climate action have been growing in number over the last year or two. And we've seen more direct actions with, the board divestment action by engine number one on ExxonMobil was a very clear example of how this movement is growing. And of course, for oil and gas companies as well, in the last year or two, we've seen some major new shifts, particularly from European oil and gas companies, establishing new transition plans that have quite far-reaching implications for these companies and for the industry as a whole. Now, this is all with good reason, of course. The IPCC has never been more unequivocal about the need for 1.5C and how crucial it is that we keep warming to that amount in order to avoid very, very serious effects of climate change. Now, what it means in practice to actually go for 1.5C or net zero 2050 is quite stark. So what the IEA said in their report from May called Net Zero Emissions by 2050 is that net zero 2050 means no new oil and gas projects can be developed after 2021, which of course is a very, very stark implication. Clearly, there's no way of getting to 1.5 without very sharp declines in fossil fuel demand. That's something that companies need to be prepared for. And I should note that this is already allowing for a healthy dose of carbon capture and storage. So that isn't really a get out of jail free card. So there's still a lot of fossil fuel demand needs to be removed in the next 30 years. Now, just to be quite blunt, what does this mean in practice? Well, it means that currently sanctioned assets, produce over their natural lives without any replacement. And that means, of course, that companies' output falls sharply over the next decade. Globally, 40% lower for oil and gas production by the 2030s compared to today's levels. Now, we sort of looked at this and split this out by various themes and also by companies. And to do this, we used Rystad Energy's base case projections for sanctioned production. So comparing production in the 2030s with today's levels. What you see here is sort of this broken up by various production themes. You can see the level in 2021 and then the level in 2030 to 2040, with the blue chunks slightly confusingly, and I apologize for this, not sort of labeled out on the legend, but really indicating just how much production disappears from sanctioned assets. Now you can see that production declines depend quite significantly depending on the resource theme we're talking about. So shale obviously has higher decline rates, as is well known, and so relies more on new assets to maintain production levels. And so in a scenario where you don't sanction any new projects, shale production falls very quickly. We see that for shale oil, it's nearly 90%. For shale gas, it's nearly 80%. And of course, this might mean that shale becomes an increasingly tough sell as the pace of transition increases, and especially if the world starts heading for 1.5 in a much, much more serious manner. And as we'll see later, even if we allow for some new assets, shale actually struggles to compete in that sense as well, but we'll return to that in a later slide. Now, if we break this out by company instead, we can see these results sort of echoed as well. So in the report, we show what the top line conclusion of no new project sanctions means for the 40 largest listed companies in the world. right off the bat, we see that half of these companies see declines from sanctioned production of at least 50% over the next decade. So quite sharp decline. Again, we see that shale fares quite poorly, as we saw on the previous slide. You can see that indicated by the orange companies here. Some very large American shale companies have declines of up to 80 to 90% over the next decade. And, you know, you can see that only really one company grows under this assumption, and that is Saudi Aramco, and that's really just because of their large spare capacity from mature producing fields. Now, if we look at the majors, we see that they're bunched around the middle. The most exposed companies are ConocoPhillips, Equinor, and Chevron. Now, this is, of course, ConocoPhillips is a shale specialist, so that explains a large part of that effect. But it's also a question of sort of lack of diversification. So, for example, Total Energies, which is the least exposed one in this perspective, has equity shares in some large and low decline fields in the Middle East, for example. Now, of course, you might not think that 1.5 degrees C or net zero 2050 is desirable. And of course, investors will have their own opinions about which pathway they want to align with. And so we wanted to consider, of course, slower, quote unquote, slower decarbonization pathways as well. Now, I think the key point here is really that these, even a slower scenario, like, for example, the IEA's sustainable development scenario, which is equivalent to 1.65 degrees of warming or net zero 2070, is still a major challenge to the industry. You can see that demand for oil, as we see in this chart, falls quite rapidly from today's levels. And just as a side note, you can see here how demand in the NZE, or the net zero emission scenario, which is what we were talking about in the previous slides, falls below the supply from sanctioned assets, meaning that there's no room for new assets. But what you can see is that in the SDS, there is a small supply gap. So there's a small gap between the demand in that scenario and the production from sanctioned assets, which suggests that there's room for some new projects to be developed. Now, of course, the risk is, however, that the industry simply continues to invest and produce along a business as usual pathway, or BAU, instead. So the way that we proxy a sort of BAU pathway is using the IEA's STEPS, stated policy scenario, which is equivalent to about 2.7 degrees of warming, and incorporates only the currently sort of promised policies by governments. And you can see that there's a massive chunk of production that doesn't fit within the SDS that would be going ahead in the steps. And this is really the stranded asset risk that we're trying to highlight in this report. Oops, sorry. So the major question, of course, is, and what investors really want to know is, which assets will be filling this supply gap that we just saw, and conversely, which assets are not going to be covered in that supply gap and will be likely to become stranded. Now, our approach will be quite familiar to people who have read our previous reports, and it's quite simple, really. We assume that new assets, new project options, compete on a cost basis, and that sort of fits with how the industry usually acts. Of course, there are other considerations when sanctioning a project, like adequate diversification, timing of cash flows, perhaps even environmental concerns. But really, the fundamental reason behind sanctioning or not sanctioning a project is whether it's profitable or not. And so it's quite a reasonable assumption to make that this is what will happen going forward as well. So what we do is that we look at aggregate supply and demand for the next 20 years, using supply data from Rystad Energy, and, as I've already mentioned, demand scenarios from the IEA, International Energy Agency. We look at this on a global market, model this on a global market for oil and for LNG, while for gas, we model this for 5 regional markets to reflect the fact that gas is usually supplied on a more regional scale, and only some of it is supplied globally by LNG. I should mention as an aside that carbon prices, we often get asked about this, carbon prices are incorporated into this assessment. So both today, in terms of what break-evens, project break-evens, we look at for projects, but also, of course, for the future, because demand scenarios incorporate assumptions about rising carbon prices, and that includes the SDS. So what we do is that we assume that anything that is currently sanctioned will continue to produce. That capex is really sunk, and companies will just continue to produce those assets, trying to recover any investments they've already made. The cheapest new project options are the ones that will satisfy the remaining demand in a given scenario. So if we think back to that supply gap that we looked at a couple of slides ago, we assume that the cheapest projects will fill that gap. What we're looking at here on this chart is the cost curve for oil from oil fields. So from cheapest on the left to most expensive on the right in a cumulative sense over the next 20 years. And you can see that the supply gap for the SDS is 5 million barrels per day, while for the steps, it's more like 20 million barrels per day. And so any project that is sort of cheap enough to fit within that 5 million barrels per day gap, which equates to a sort of a project break even of about $35 per barrel, that will be considered to fit within the SDS. Whereas anything above that will be considered to be at risk of being stranded. Now, what we're interested in is really the portion between the SDS and the steps, assuming that companies continue to invest along the steps or the business as usual pathway. What is the sort of surprise gap between that and a low carbon transition pathway? Of course, it's worth mentioning as an aside here as well that in the NZE, the net zero emission scenario, no new projects go ahead, and so the supply gap is zero, and the marginal break even is also $0 per barrel. No new projects happen. So let's look at what this means in practice in terms of capex and capex at risk. In this chart, you see for different extraction themes, the same ones that we saw previously for production declines. You can see the different sort of portions of capex, with the blue representing what is considered inside the SDS, cheap enough to be inside the SDS. The orange representing what is outside the SDS but inside the steps, which is a surprise gap that I just mentioned, whereas the red chunk represents what is too expensive to be consistent even with the steps. This is only for unsanctioned assets again, where sanctioned assets are assumed to go ahead regardless. Now, the big conclusion to be drawn from this chart, I think, is really that most project options are not needed in a low carbon scenario. What we find is that there's $1 trillion of capex over the next decade that would go ahead in a business as usual pathway, but that would not be consistent with the SDS, and so would be at risk of becoming stranded. Now, much like with 1.5 or net zero 2050, shale oil fares quite poorly in terms of new projects as well. And that we can see that in the middle with the tallest column also has the largest amount of steps capex at risk of stranded. So not only does shale decline fast in a sort of no new sanctions world, but also if you allow for some new sanctions, it actually struggles to compete as well, which makes it a very quite a tricky double whammy. And I'm sure it's probably quite a jarring conclusion for some people. Within the conventional space, conventional production, we see that deep water is generally more exposed, which fits with the sort of complexity and higher capital intensity of those projects as well. We can also see in the minnows on the right, it's harder to see because this is shown in absolute terms, but it's worth mentioning that oil sands see virtually no new projects go ahead over the next 10 years. Of course, there's still sanctioned production, but in terms of new products, virtually nil in the SDS. Now, I did just want to sort of break out the question of gas and LNG a little bit, because that's something that people mention a lot and ask about a lot in our presentations. It's worth mentioning that, in the SDS, of course, oil demand falls faster than for gas, and this is been cause for optimism with many oil and gas companies as well, who continue to tout gas and particularly LNG as a sort of source of growth, even as they start to decarbonize their overall business. But what we find is really that the transition fuel narrative is starting to weaken, even if it's weakening sort of slower than perhaps what the narrative for oil is. Gas demand is increasingly being threatened by low-cost renewables. Our colleagues in the power and utilities team have released a lot of incisive reports about how new gas-fired power plants can be undercut by renewables, and in fact, sometimes even existing gas power plants. And so that's something that companies need to really watch out for and be aware of, lest they spend another decade investing heavily in gas, which creating assets that could become stranded as well. Now, just on LNG in particular, we see that there's far more LNG project options, that is unsanctioned projects that have capex associated with unsanctioned projects, than are needed even in the steps. You can see the big red bars, effectively all the possible projects that companies could do over the next decade. And only a very small portion of that fits even in the steps, which is a business as usual pathway, and of course, even less in the SDS. And again, nothing in the NCD. And there are examples of companies already sort of getting cold feet on LNG. There's, for example, Kitimat in Canada was recently, both Chevron and Woodside, the main partners in that project, got cold feet and sort of have been wanting out of the project. And so, although other companies are quite optimistic about LNG right now, there's huge risk that this could change over the next few years. So finally, let's just break this up by company as well, which is, of course, what investors are really particularly interested in. Now, the main general point is really that company capex exposure varies quite significantly, and that it sort of reflects the underlying portfolio project options that they have. So what we see is that theme results are again echoed in these rankings. So we see that deep water specialists, shale specialists, oil sands specialists tend to be some of the more exposed. So for example, Pioneer, shale specialist, Suncor, oil sands, Petrobras, deep water, and so on. These companies tend to be more exposed. Now, I did mention briefly earlier that projects that are too expensive to fit within the steps, we assume that they are sort of not likely to go ahead. This is really just to make our results more conservative, but actually there's a caveat to that, in that some companies do still consider some of those projects as being viable for sanction. So for example, you can see that Woodside towards the bottom of this chart has quite a large portion of potential capex outside of the steps. And one of those projects is Pluto LNG Train 2, which we find doesn't fit within the steps, but is still very much up for sanction and was an integral part of Woodside's recent merger with BHP's oil and gas assets. So that's something to keep in mind, that even though we, for conservativeness sake, exclude the above steps portion, investors will still want to query that with companies and make sure that some of those projects are not going to go ahead anyway, because they're even at greater risk of stranding. Now, finally, just to think about the majors, what we can see here is that their positioning on this ranking matches their ranking on emissions goals that we explored in our report Absolute Impact 2021 earlier this year. So some European companies like Eni and Total Energies are some of the least exposed, and they also have some of the strongest transition plans, whereas American companies like ConocoPhillips, ExxonMobil, Chevron are most exposed in terms of capex alignment, and also have the weakest emissions targets in our view. And that's an interesting sort of correlation between between these two factors, which perhaps it highlights a broader approach to transition planning. Finally, just a point on exploration. So what we find is that despite this massive overhang of capex, and despite the fact that many companies are now starting to say they're net zero 2050 aligned, exploration for new assets continues at a very significant pace. So we've seen some anecdotal examples in the last year. So in June, Norway awarded Arctic exploration licenses in the very frontier Barents Sea area to Equinor, Shell, Vår Energi, which is owned by Eni, and OMV. And these are all companies that have net zero 2050 target. And so it's odd to us that they are committed to rapid emissions declines, but still exploring for new assets. And we saw other examples as well. For example, Chevron Total Energies picking up licenses in Suriname. Now, it's an additional point as well that companies continue to spend a lot of money on exploration, even in 2020 when demand outlook was so poor. The biggest spend was actually by Chinese companies, but after that we saw that Shell was the biggest major to spend on exploration last year. And that sort of indicates an interesting disconnect between what companies pledge to do and what they actually do. And of course, this is completely at odds with the IEA's interpretation of net zero 2050, which says no new sanctions, let alone new exploration. So this leads to a few key investor considerations to take away from this. First of all, if companies claim to be aligned with 1.5C or net zero 2050, can they really justify new sanctions? Obviously, the IEA says no, but our data also shows that that's a tough sell. Now, regardless of whether you are aligned with 1.5C or 1.65 or any sort of other transition pathway, it is crucial that companies have a strong transition plan to prepare for a low carbon world with lower demand and lower revenues, with greater stranded assets. And companies really need to show to investors how new projects are compatible with Paris and how new project sanctions are compatible with that. Now, of course, transition plans can take different forms, and I think it's up to investors to decide what they find is appropriate for the company, given their structure and competitive advantages. The key thing is that these plans reframe the business away from oil and gas rather than using stopgap measures like offsets, nature-based solutions, and perhaps even carbon capture and storage to maintain business as usual. That's something that really only kicks the can down the road without really addressing the fundamental transition risks that companies face. So it's important that investors push companies on portfolio resilience, like we've shown in this report, but also on other issues that tie into this to a broader package of being Paris aligned or being transition ready. So having strong emission targets that incorporate things like scope 3 emissions, interim targets, and a full coverage of the company's activities, having strong remuneration policies that don't incentivize new fossil fuel growth, and having conservative impairment prices that actually align with the transition pathway that the company claims to be aligned with. So again, just the key messages to sum up. 1.5C/net zero 2050, which again have similar implications, means no new oil and gas projects, meaning again that production falls very fast, and companies need to be prepared for that if they claim to be net zero aligned. The low carbon transition, regardless of whether it's 1.5 or 1.65, means that fossil fuel demand falls fast, and companies then face stranded asset risk that they need to start to address now. And so investors need to ensure that companies change right now in order to protect both the climate and the value of their own investments. All right, that's me. Thanks very much.
Fantastic so much, Axel. And maybe we can also have Mike come on the call here now. You are there, that's good. We have a couple of questions coming in from the audience, but maybe I just wanted to take a little high level and maybe end a little bit on where you are. So what would you say are really the key takeaway in an investor? How can they use this research, and also for the companies, the mentioned companies, how do you think they should approach and utilize this research?
Right, thank you. So I think one of the things that we often reiterate when we're talking to investors is to make sure that companies are aligned throughout their business with what they claim to be aligned with internally. So when companies say that they are net zero 2050 aligned, for example, you need to really query how that's compatible with the goals and targets that they've set out for themselves. So for example, if they say that they're net zero 2050 aligned, but they still plan to increase production over the next 5 or 10 years, is that really feasible, and does that really work on a global scale? And if they plan to rely on, for example, carbon capture and storage, that's obviously very speculative. Is that credible? Is that something that they can reliably do, or do they need to actually hedge their bets a little bit more? We hope that these the results that we present today can be a very good ammunition for investors to really query companies that can otherwise perhaps be a bit opaque in what they do, and specifically to lift out projects that may seem to be very high cost to make sure that they actually align.
And that maybe tie a little bit to some of the things you discuss in the report about the pathways, because net zero is not really the end goal. It seems that may be where we want to get to, but how we get there and how that looks. So can you talk more about why is it so important for investors to really fully understand the pathway to decarbonization that the companies are choosing?
Well, as you say, I mean, net zero doesn't mean all that much in itself. It's really the temperature outcome that determines the speed at which you need to transition, and that it's generally difficult to, if you're aiming for net zero 2050, then the speed at which you need to transform is really not that different from 1.5, because you can't put these things off for 10, 15 years and then rapidly shift, because there's just such a massive transformation that needs to happen. And so I think it's extremely important that investors are querying companies on whether they're acting fast enough. And I think in many cases they aren't. And it seems to be that they're sort of using perhaps some delay tactics, or at least being vague in defining how they plan to reach net zero 2050. Mike, I'm happy for you to add some of this, because you've been leading in our work on emissions targets, which of course incorporate this so much.
Yeah, thanks, Axel. I think I'll just add on that a few points. I think the first would be, as Axel rightly says, it's the temperature goal that really matters here, and it's the pathway towards that. Ultimately, the pathway is defined by the aggregate amount of emissions. So we previously defined in the Absolute Impact Series of report 3 hallmarks of Paris compliance that we see that company emissions targets must or should fulfill to those companies potentially to be considered Paris aligned. Those are having goals that include end use emissions, so the full scope 3, so ultimately when fuels are combusted, that you have an absolute basis to interim targets rather than an intensity basis, because clearly an intensity basis doesn't actually link to the carbon budget. And we need company targets to consider the full or cover the full range of activities on an equity share basis. Now, the reason I sort of highlight that in this context is, as Axel says, a growing awareness around getting the 1.5 degrees, so that stretch goal of the Paris Agreement, limiting global temperature rise to 1.5, and then this concept of net zero 2050. Now, as Axel rightly says, it's sort of being used a bit synonymously at the moment, but the key thing is to realize that a net zero target can be very different between different companies. For example, some companies have a net zero scope 1 and 2 emissions target, so just covering the operational emissions they have, ignoring the 85% of emissions that result from the end use of those products. So for both the benefit of the climate and preserving shareholder value for investors, it's critical that company targets cover those emissions. So a net zero target, a company might look to have a net zero target. However, we need to be very clear that a net zero scope 1 and 2 emissions target is a very, very, very long way from a target that's aligned with a 1.5 degree scenario, despite the use of the term net zero with it. So I'll just leave it there.
Fantastic. And then, so maybe when we have seen over the last year or so that net zero has been here, there, and everywhere, and we have net zero alliances but among investors, bank, insurance, Canadian oil sands companies, etc. What are some of the rationale or the reasons why oil and gas companies continue to explore and also acquire higher cost reserves or resource bases if they at the same time make net zero commitments?
Well, I think there's a couple of things. One of the things is that companies hope and expect to be able to find cheaper resources, cheaper assets to perhaps replace what they already have. Now that's taking quite a big bet, and in some ways it doesn't feel very very credible. For example, when we're talking about Barents Sea in Norway, which is a completely frontier, largely unexplored, who can tell really whether that will be cheaper or not? Then I think it's clear the companies are taking a big bet really, and they're just they want greater reserves. And I think that speaks to the second point I would make, which is that although companies are willing to transition over the long term, I think many of them are still skeptical about the pace of the transition over the next decade. And that's a problem because, of course, we know from not just from, for example, from the IPCC's analysis that we need to act very, very rapidly and from today, 45% emissions reduction by 2030 in order for us to be able to realistically hit 1.5. And so to assume that we won't be able to move fast enough in the next decade is really to consign 1.5 to the dustbin, and that's obviously not a good thing.
Fantastic. And so no new project is one of the key headlines that, of course, comes out of this year, and you imply and you use this new implied production decline, and wondering, is that a metric that we think we could develop further to start to distinguish and look at the companies? And maybe as a tie into this, at least internally, we have had some discussions about some of the data made available from the IEA on this scenario is not as complete as we have seen with the SDS and the B2DS and other scenarios there. What are some of the data we would like to see more out there so we could dig deeper down and actually make more granular level analysis?
Yeah, so one of the fundamental bits of data that we're missing from the net zero emissions scenario is the regional demand outlooks, particularly for gas. Like I mentioned, gas demand is so regionalized, and only some of it is able to flow freely around the globe via LNG. Most of it is piped really and sort of quite regionalized. And so the fact that the NZE doesn't have that data makes it difficult to make a very accurate picture of what the different balances will look like in different regions. And so that's a bit of a shortcoming. I think another interesting point to develop further, which we didn't really weren't able to develop in this report, is the question of what happens to sanctioned supply, because as I showed in the chart on oil demand, of course, the demand falls below sanctioned supply, and so there's an implication there that perhaps even some sanctioned projects could need to be shut in. That's not something we actively explored in the report, but it's something that will be, I think, important to consider as well. Hasn't really been necessary to consider until now, because of course there's been a supply gap, so we need more oil, and that's been the narrative for decades. But now we're moving to a completely new paradigm where we need to think about the possible risk of shut-ins.
Great. And now we'll jump over and take some of the questions from the audience. And that was, we will probably not have time to go through all of them. Please put in more questions, and we will email them back, come back with responses to the participants here. But there's a quick question on what really happens for the auto sector if we foresee a sharp decline in the oil production by 2030, because currently around 90% of the world's vehicles are gasoline cars. I think Kingsmill Bond, who is our new energy strategist, he has quite strong views on this area. But I think what you have just said, Axel, is that we still have a lot of excess supply compared to falling demand. That means prices are probably coming down. So it doesn't really matter so much from the oil and gas companies. They don't want to go out and produce cheaper oil production out there. And you have seen the car manufacturers are investing heavily in decarbonization or electric vehicle areas. So it's probably not an area where it really matters overall that much what the automakers are already adjusting their portfolios there. There was two quick questions on the data. I saw Mike already answered another one here, but the supply curve data we have here, do they include transportation costs to the market, or are they at well level? And also, what assurances are we having on the Rystad data?
Right. So on the point of transportation costs, yes, they do include that. So, for example, oil sands will have an adjustment upward in break-even prices to account for the fact that they have a more difficult access to market and need to sometimes be put on trains, which are more expensive and so on. That is incorporated in the break-even price. On the second point of assurances about Rystad data, I think the question is whether we can trust the Rystad data, perhaps. Yeah, so of course, the alternative would be to go to each company's own disclosure and try to sort of patchwork together a database of different projects and assets and so on. Well, that would of course both be not quite feasible for us, but also I think it's the benefit of using a single database from a single provider is that you have a common set of assumptions about things. For example, decline rates for sanctioned assets. Rystad will have a consistent set of assumptions about how this works for different types of fields and across different assets. Whereas if you took it from different companies and their own reporting, if they even reported this, because of course it's company secrets effectively, some of it, they would have their own assumptions and their own IRR assumptions and all that stuff. So we do quality control on the data and to make sure that it's consistent and free of errors. But it's at least we prefer to have take from one database with a single set of assumptions.
Yeah, I think, thanks, Axel. I think I'll just add on that point. Really important to reiterate here that what we're doing is looking at the relative costs of the different companies and the different projects. So we look at using that cost curve Axel showed, we are looking at the relative position of projects versus others, and we're looking at aggregate supplying and the scenario creates an aggregate demand over the next 2 decades, and we then look to supply that by going up that cost curve. Now, what's important is the relative positioning of projects, not the absolute cost of those projects. So, of course, we often hear, and we've heard directly from companies before, saying that, oh, well, the projects in Rystad are too expensive, Rystad is overestimating our costs. But ultimately, a number of companies have said that, and I'm sure everyone would believe that, everyone would say the same thing, but they cannot all be true. Ultimately, there is a set of projects which need to stay in the ground to avoid breaking the carbon budget. And it's really important that we recognise that this is a relative piece here. The break-even prices shown on the y-axis that come out of the cost curve, those are a result, an output of the analysis. Those are not an input. So that cost curve does change over time in terms of the absolute dollar amounts, but the relative positioning of projects stays broadly the same. And it's the relative positioning that ultimately feeds into the company relative positioning and the quantification of stranded asset risk here.
Great. And then we are coming towards the end, but I wanted to highlight a bit because you are looking at in the net zero world on different themes or thematic areas of national oil companies. You have shale companies and that type of thing. So on the chart you also showed here, it seems that the shale companies are more vulnerable, whereas some of the oil sands companies are maybe more protected in this world here. Some of the pushback from this is based on one of the questions here. Some of the pushback from the shale industry is, well, they have shorter cycle projects, and they will only sanction these shorter term projects if the near-term price horizon or environment is supportive. How should investors think about this and companies think about this when we look the shale versus the other place here?
Well, I think as an initial response, I would just say that I would really not characterize oil sands as being protected. Yes, perhaps in the strict sense where we're talking about no new project sanctions, it is, but in terms of new project options in other scenarios, as we saw, there's basically nothing for oil sands compared to other streams. So actually, shale has much more in absolute terms in capex investment that fits within the SDS than in oil sands. Oil sands is virtually stagnant, and so I would really be reluctant to call it protected. But of course, when we're talking about production declines and that strict sense of no new sanctions, then it has lower decline rates, and so it's more protected in that sense. But of course, as I mentioned earlier, one of the things that we didn't consider was whether some projects might need to close early because of demand actually falling below sanctioned supply. And we know that oil sands is particularly expensive compared to other types of resources, and so it's quite possible that it could be disadvantaged if we took that into account.
Fantastic. I think we are coming towards the end of the line here. Maybe before we finish off here, I don't know if you have some quick thoughts on how can we ensure that when companies and also investors are talking about these net zero commitments, that they actually become more than a press release and a little bit of glory in the newspapers, but we actually get to some real impact. I think the hallmarks we have referred to might be one of the areas, but I'll leave that to you here after some of the last comments.
Yes, I mean, not to toot our own horn too much, but of course this is a CTI webinar, and we put out a lot of analysis covering a lot of different angles and aspects of companies' sort of Paris alignment, which covers a broad spectrum of things. So there's the capex alignment piece that we talked about today, but as I mentioned, we've also done analysis on emissions targets and what sort of, like you said, the hallmarks of that are, and what sort of some very concrete principles that you can evaluate these targets on. We've also looked at remuneration policy and some principles around that, and so it's obviously quite complex. But hopefully we provided, there's a lot of material on our website that I hope people will go seek out, because we've covered a lot of different angles of this effectively.
Fantastic. And I think we come to the end here. There are a couple of more questions. We'll try and come back to people on this. You're always welcome to contact us. Our website is carbontracker.org, which if you don't know, emails addresses is first name initial and last name @carbontracker.org. Next week, Thursday, the 23rd of September at 10 a.m. Eastern time, East Coast time, 3 o'clock UK time, we will have a webinar discussing this here with a panel of different investors and other users during New York Climate Week. And otherwise, please contact us for if you want to dig deeper into the research. The report is available on our website, and we will also make the slides available upon request. With that, I want to say thank you to Axel, thank you to Mark, and to Mike, and to everybody on who participated here. And carry on, have a wonderful and productive day, not using too much carbon emissions.
Thank you.
Brilliant.
All right.
Thanks, everybody.
Bye.